This is a Momentum Media production.
Welcome to the Smart Property Investment Show, the podcast by investors for investors.
Well, good day everyone. It's Liam Garman and Emilie Lauer, the co-hosts of the Smart Property Investment Show. And we're on the precipice of a pretty big year in property, and just months away from a federal election, has to be held before May 17, and potentially just a week before our first rate cut in quite a while. We're expecting quite a bit of air behind the industry, picking up property prices and giving some good returns for investors up and down the country. But before we get into that, Emily, how are you going?
Yeah, pretty good. Sun is shining.
Sun is shining.
It's a good week in Australia.
It is.
Loving it, yeah. That's what they promised me at immigration.
You did get through. Yeah.
What would you do without me?
No, I know. I would crash and burn. That is true. We do have a pretty bumper year ahead.
Yeah, it's quite intense. Even for us in terms of news, here at the team down at Momentum, just keep on going, like every single day, more news happening. And I think one of the big news that happened recently are the consumer price index results, which have rose by 0.2%, meaning that they are now in the RBA brackets for a rate cut. So they are now, inflation is down at 2.4%, which is
It's pretty fantastic. So I think that takes a lot of discussion out of theorising when interest rate cuts would be. Obviously, at the end of last year, a lot of people said, well, interest rate cuts might not be as soon as we expect because that trimmed mean inflation is still a little bit too high. And there's something that I've been very vocal on, Emily, is that a lot of the inflation is government-led.
It is, yeah.
It is. The government can't come out and say, well, inflation's dropping. Well, most of the inflation dropping was as a result of $300 energy rebates, which is going to wrap up. It's as a result of a lot of subsidies, which are going to wrap up at some point in the future. Because, you can't run a government debt and deficit ad infinitum. We've already seen other countries across the world start tightening up that government expenditure. So a lot of that inflation reduction was actually very artificial. The base cost of a lot of goods was still quite high, which meant that a lot of financial institutions, a lot of banks said that, without the subsidies, we don't really think that we're in a position to cut interest rates. And there is a risk that if you cut interest rates too high, you add artificially money back into the economy where that money should not have been. And a great example is at the moment, a lot of financial professionals are actually predicting that the US economy might be at the forefront of a potential rate increase cycle again. And why is that? It's because the economy's hot. The economy's doing pretty well over there, notwithstanding the political vicissitudes, the political ups and downs. The economy's super hot. They've just come out of a rate cutting cycle. It seems to be performing better than people have expected. So now you might actually be going back into interest rate hikes. So with all of these things, we've now maybe turned a corner that in December last year, CPI is lower than we've expected. That trimmed mean, when you get rid of the subsidies, when you get rid of the government expenditure, is edging closer to that 2 to 3 band. I think it's at 3.2% at the moment.
Yep.
So we actually might be on the eve.
I think we are. Look, I think a lot of people are still very cautious about this, but the banks have actually all moved their prediction, which was in May for a first cut, to February. So Westpac has just brought forward his cash rate forecast in February. The NAB has done that as well, which means that now all the big four banks, CBA, Westpac, ANZ, and NAB, are aligning for a February 2025 rate cut. Now, until the RBA meeting is happening, which is, I think, 18th of Feb, if I'm not mistaken.
14?
8.
One of them will.
One of them will.
One of them will be correct. 17.
Here we go.
14's Valentine's Day.
Yeah, it's the 18th.
That's a Friday? You're right. Why do I even question you anymore? It makes no sense. Okay.
Look, just follow my lead.
Look, our readers and our listeners know I'm incredibly slow. Slow.
You're not. You've got too much on your plate.
If Emily and I ever disagree, go with Emily.
I like that. So look, now the banks have aligned that the RBA meeting is happening on the 18th. So until that meeting is happening, we still don't have a real rate cut. So a couple of weeks to go. Now, while all the banks are agreeing that a rate cut will happen in February, the number of rate cuts is still up for grab, and it's still like a wild debate out there.
Yep.
So ANZ is forecasting 2 rate cuts. CBA and Westpac, they are predicting 4 rate cuts, and NAB is alone with 5 cuts for next year, which is quite interesting.
That's a lot, because I want to taper expectations for a lot of our listeners, because a lot of our listeners will think, oh wow, a rate cut cycle will lead to a whole new era of capital growth. There are several parts of this. The first part is banks might not pass it on.
Yeah.
That's one. The second is, and if you want to go listen to it, listen to the recent Secrets of the Top 100 Agents on Real Estate Business. I recently had to sit down with one of Australia's best, and I mean that truthfully, one of Australia's best speakers, trainers, coaches, Josh Fegan, who unpacked, well, the outcome of a rate cut cycle might not be as pronounced immediately as we think. So if you have a 50 basis point cut, which is, typically the RBA moves up and down by 25 basis points. But if you had a whole 50 basis point cut, that calculates to $80 a week. That ain't much.
No.
And he brought up a fantastic equivalent, which is $80 a week is really, the second another Middle East crisis happens, right? It seems to flare up twice a year. Happens twice a year. There's a Middle East crisis. The second that next Middle East crisis ticks up and you drive to work, or you drive around, you drive your kids to soccer practice, or you drive them to sport on the weekend, and then fuel's back at $2.50 a litre, you've eaten mostly into your $80 already.
Yeah, no, it's not that
substantial.
much.
So the thing I think will be the major difference is the borrowing capacity as a result of that, because if you factor in that $320, I think it is a month over the course of 30 years, then yeah, sure, you'll have a bit of a bigger capacity. But don't expect that if you've got this $800,000, $900,000 investment home that's going to suddenly spike to 1.1. It really ain't going to happen. What you would need to see is those multiple cuts like you've identified, but at the same time, those multiple cuts which don't immediately have too much of an impact in the market. If the rate cuts are too successful, then it's going to hover or go back up.
Yeah.
We can't just expect that we live in this magical world where asset prices always increase and that interest rates are always low. That doesn't exist. So these are some pretty important points for consideration.
Yeah, and I think that's where investors will have to decide between fixed rate cuts and variable rate cuts. Talking about fixed rate cuts, NAB has also actually lowered its fixed rate cuts. So they're now at 5.84% for a 3-year terms for owner-occupiers on a 20% deposit. Look, the move follows, of course, the CPI results, but it also follows Macquarie's Bank, because Macquarie's Bank had reduced its fixed rate in mid-January, offering...
5.55.
Sorry?
5.55.
Yeah,
That's
5.55.
That ain't bad. That is indicating quite a long-term cut cycle. Although, one thing I will say is I had the opportunity to sit down with the fantastic buyer's agent, Simon Liu, who is the founder of House Finder, on a Property Unfiltered podcast just a few weeks ago. And he brought up something which was really interesting. And it was almost a little bit of an inversion of what I've always thought, which he was kind of like, don't sweat the details. He's like, if you're debating the 0.0% in a interest rate, you're not doing yourself a service, because what you're doing is these are long-term assets. These are assets that you want to have for a very long time, or you're going to be playing the debt game. You're going to draw down on your equity. You're going to buy more. This is a very dynamic thing that you're moving into. Well, on the one hand, it's dynamic when you're playing the debt game. On the other hand, it is if you want to hold on to it for 30 years, so you have an asset that's completely paid itself off and is earning your passive income, you can do that as well. So when you're playing with a 0.0% of interest rates, and you say, well, I'm not going to go with that because, it's way too high, because it might be, like a 20th of a percent higher than another bank, but that other bank won't lend to you because the serviceability frameworks that they have in place. Well, you're kind of robbing Peter to pay Paul in that sense, because you're stopping yourself from buying another property for something that ends up being like $20 a month.
I think it's all about calculation. Yeah, definitely. Yeah, I think it's very interesting, and I think it's going to impact the market a little bit. I think we're going to see a surge in buyers if the rates cut.
So what are the lowest rates that we're seeing at the moment?
So the lowest rates for fixed rates is SWS Bank, because they offer rates just below the 5% mark for 3-year terms with a 800,000 plus loan.
That's
for owner-occupiers.
Wildly low.
Yeah. I think it's just a question of knowing if you want to keep the rate fixed or not. I don't know. I think it's a choice to make.
Now, on that note, we're going to go to a quick break, and when we're back, we're going to be talking about how land prices continue to surge nationwide, and we'll be back in just a second. Liam Garman, Emilie Lauer from the Smart Property Investment Show, and one of the key takeaways I took from 2024, now 2025, Emily, was that property price increases aren't, a normal curve. It's not on normal distribution in terms of every asset, every different asset type, every asset class going up in a uniform manner. One thing that I found super interesting was that, and it makes a lot of sense from a kind of traditional economic arbitrage point of view, which is your bottom 25%, your bottom quartile of assets were going up at, I don't want to quote, it was in the 20s in terms of percent asset increases versus your top quartile, which is kind of in that low to mid single digit growth range. And it makes a lot of sense because on those blue chip stocks, if you say, I'm using blue chip stock now quite liberally. Yeah, if you bought in Vaucluse, if you bought a house in Vaucluse, you would have expected quite large year-on-year growth, and you would have seen it really kind of up until now where your growth is going to be single digits. And in terms of a yield, that rental income that's deriving for you is super low. It is super low. You really would be in a far better state unless your ego gets in the way. And this isn't financial advice. I don't know your intricate financial details, but most investors will be in a place where, if you sold your Vaucluse house, you could probably buy 20 places mortgage free in outer urban metropolitan areas, and then be just raking in hundreds of thousands of dollars a month in rental income.
Yeah, but Vaucluse.
I know, but
I mean, it's one of the most beautiful places in the world.
I know.
Definitely.
And I know there's a lot of people that won't because they'll be worried that they can't get back in. But also at the same time, Emily, you and I host enough of these podcasts. We've had enough smart people on who have done the maths. Done the maths. Actually, one person I will reference back if you want to hear a breakdown of the maths. It was on the ADF Property podcast with Kane Drury, and he broke down the maths really well, which is, if you buy some of these houses and you have this passive income, the cost for you to rent in a nice area, you can be renting in a nice area and then put your money in investment properties. You can reinvest and you can have your lifestyle in a nice area. You can have your passive income. You can have lower debts, lower liabilities, and you have your cake and eat it too. So there are ways, and we've done the maths 1,000 times. But in terms of this, obviously, not every asset class has gone up at the same rate. Not every asset class has gone up by the same percent. Though, over the last 12 months, we saw land prices surge by 7.6% nationwide. Emily, what's going on here?
Yeah, so look, it's quite intense. So the median prices of land in Australia has increased by 7.6%, reaching now a median of almost 367,000 in the Q3, in the third quarter of 2024. Land prices have now risen more than twice the rate of the CPI index and 5 times faster than building material costs. And we know that building material costs have increased quite a lot. Now, in terms of capital cities, we saw a 9.2% rise in the median land prices, with Perth having the highest increase with 38.6%.
That's
Wild. And Brisbane followed suit with 21.2%. Now, Sydney increased by 7.2%, which is right below the median, but the land prices now reaches 710,000, which is one of the highest in the country. And yeah, that's quite a lot. Now, compared to capital cities, regional areas have increased by 2% to almost $282, which has
$1,000?
Sorry, 1,000. Oh my God, I wish.
Goodness. Where are you getting this?
200. Look, I need another coffee, I think. $282,000, which has increased buyers' interest because it's quite affordable compared to city and even compared to the median price.
Yeah.
I mean, now with the commute facilitated, people are definitely flying to city markets, regional city markets.
Now, obviously, this has a fair few flow-on effects, especially in terms of housing supply.
Oh, yeah.
Obviously, the government's got their $1.2 million home housing accord by 2029. Now, it's an interesting conundrum that we're in, given that you've got, well, a lot of people are saying, supply is the way out of the housing affordability issues that we're facing. So we've got to increase supply. But how exactly do you do that when, if you take Sydney, for example, how do you increase supply if your median land price is increased to $710,000? Your build, on top of that, your build will be in the several hundreds of thousands of dollars, and every other step that accumulates, every other cost that accumulates, you'd be renting while you're building, et cetera. So there are actually structural issues in the way of increasing supply, and this is one of them. And there's also huge stamp duty concerns.
Yeah.
So when you have such high median land prices, you're going to create more barriers to people buying them. And especially if you're a first home buyer. I know you recently launched a new podcast speaking to our first home buyers, but if you're in that field and then you're facing even more costly stamp duty, it seems like supply issues are going to be here with long term. And I know you're about to say something, but this bodes well for investors for capital gains.
Yes.
Now, I'm going to say well with a fistful of salt, because for a lot of people looking to get on the property market, less so, obviously. And it is something that needs to be addressed, needs to be something that is addressed very quickly. But for people looking for capital gains, it seems that 2025 is not going to be the year for a boom in housing supply. At least looking at this data, we might say differently in 12 months' time, but looking at the data in front of us, we might not be there.
Yeah, no, I think, look, the house supply, as much as the government is trying with that national housing target, we're already so much behind. We are so much behind in the building and in the supplying, which is quite a concern for all the peak bodies that have been very vocal about that lately in terms of supply and affordability. But yeah, we'll see how it goes.
Now, we're going to be back in just a second, and we're going to be discussing national home values. We'll be back shortly. Liam, Garman, Emilie Lauer, the team behind the Smart Property Investment Show. And just before the break, we were discussing how land prices have surged by 7.6% nationwide. But this isn't necessarily mirrored in the cost of the average home value. Emilie, what are we seeing here?
Yeah, so compared to the land prices that have surged by 7.6%, national home values have held steady. They've had a very, very slight decline by 0.03% across the nation, with capital cities seeing a 0.2% drop and regional area growing by 0.4%, which actually avoided themselves. So now regional market.
For our listeners, Emilie explained that with her hand. She's like, oh, this is they zero-sum game. They cancel each other out.
Yeah, they cancel. That's what I mean. Yeah.
She's kind of trying to describe a magnet kind of thing.
Same, yeah.
So that's the context there.
Look, the thing is, regional market, they saw a huge growth by 5.8% annually, which have outperformed all capital cities across Australia, where the growth has slowed. Melbourne saw the sharpest decline last month with a 0.6% decline, and Sydney and the Australian Capital Territory dropped by 0.4% and 0.5% respectively.
I would almost be saying that Melbourne's a good place to buy. If it wasn't but they're not really being much of a long-term economy there, I can see.
Look, all the experts we've had on the Smart Property Investment Show recently have all said that Melbourne is going to pick up. Victoria is going to pick up.
That, Emily. Some have said that.
Yes, they did.
It's some, but not all. You know, I think there's still more to go in the market. I think I think there's more of a trough to hit, and for no other reason than, unfortunately, like the economy in Victoria is just shot. Like it is shot, and that's the crazy thing, because I would almost look at this from an ethical, moral point of view, which is, okay, well, at least first home buyers can find a value, a store of currency in housing in Melbourne. It's good for first home buyers. It's good for young families. But man, like the joblessness, the government coffers there, the cancellation of infrastructure projects. I don't even think there's like a long-term growth in that city. I'm not seeing it. So I would argue that there's probably a few more months of negative growth there.
Well, our next guest for the next SPI podcast, you're going to have to argue with him. So a little bit of a teaser here for our listeners.
I'll go toe-to-toe. Okay,
you go toe-to-toe, yeah. Look, in terms of growth, the strongest growth was in Adelaide and Darwin, which saw their highest monthly growth of 0.7 and 0.6%. Perth and Brisbane were due to slow at one stage or another, and they recorded 0.4 and 0.3% increase, which is quite little compared to what they recorded at the beginning of 2024. Now, despite Sydney having a slow growth, only by 1.7%, the median dwelling price remained the highest of the country, with almost 1.2 million.
Wow. And on that, Melbourne still back, minus 3.3%.
Yeah,
they took it out.
That gets your case.
They took it out. They won that. And regional Victoria, it's funny because you said before that, you know, regional areas have recorded quite good growth relative to metro. Even regional Victoria down 2.6%. And again, you can't necessarily balance this out with rental price growing either. We've seen rental growth slowing, growing by only 0.4% in January, with capital cities seeing small increases. 4.4% growth annually, which is still double the pre-COVID rate. But some of these areas, the yield might not be keeping up. Yeah,
but look, in terms of like rental, I think it's a good news for renters, of course. So the national median rent is actually at its lowest since 2021, and it only rose by 6.9% in 2024, reaching $620 per week. Look, it slowed quite a while. In 2023, it was at 20% annual growth. Now, capital cities' rent increased by 1.6% in the December quarter, with Sydney and Melbourne experiencing no rent growth for the past 6 months.
And that's probably not too bad, especially for investment properties. Obviously, people want their rental yields to go up. But when we look at the economy from a more macro sense, the fact that people now have that disposable income to put into businesses now have a chance to grow. Especially going to a rate cutting cycle, we might see a hot economy. So this downturn might be a momentary blip on the radar.
Yeah, but you know what? While capital cities didn't see that much of a rent growth, regional rent went up by 10%
in a month?
Over the quarter. Yeah.
Of a quarter?
Yeah.
Wow. That's a lot.
Yeah. Now,
that is a lot.
$550 weekly.
Yeah, wow. And what about Melbourne? How's Melbourne going?
No increase. Melbourne, no increase for the past 6 months.
Yeah, okay.
Same as Sydney. But again, Sydney, doesn't matter if you've got a rent increase or not, still the highest median rent of the country.
It's all the Bondi people. Is everyone in Bondi paying thousands of dollars per room? It's spiking it. It's an anomaly. If we got rid of the anomalies, it won't be that much.
Yeah.
That's a joke, obviously.
I mean,
partially.
The
stats actually might check out on that.
Yeah.
I don't know. I mean, I'm sure that actually, if you took out like the lower North Shore and the eastern suburbs, that it would be a massive anomaly.
But you know what? Being a foreigner here, I've met a lot of people that are sharing rooms and that are still sharing rooms.
Sharing rooms?
Yeah, they share rooms, yeah. Wow. So I know an Italian girl, there are 6 people in a flat, so 2 people per room sharing. she pays 300 per week, and everyone pays 300 per week. Done in Ultimo.
In Ultimo?
Yeah.
No.
Yeah, man.
I was expecting. I don't mind Ultimo, but I was expecting Kuchi or something.
No, Ultimo. So that's like a 1,800 weekly rent.
Wild. Yeah, don't do that. That's crazy.
Yep.
Yeah. Okay. Well,
On
power
that
to
note.
you. But I'm actually. Well, I guess I'm just confused because you can find places cheaper than that. Like I genuinely, there is a flat that was up for rent in my apartment in Neutral Bay for $700 a week, and you can have your own room.
Yeah, but
I don't get the maths. Anyway, all power to them. That is all we have time for today on the Smart Property Investment Show. Just an update of the statistics of where we are as we launch into a big 2025. But obviously, there's a lot of growth on the horizon. Maybe not the Victorian market, but I'll keep my opinions to myself because on our next episode, I'm going to have someone far smarter than me tell me why I am stupid and why I am wrong. If you want to listen to that, please stay tuned. It hasn't happened yet, so I still might win, but I don't hold much hope for myself. I'll be back with Emily very shortly with another episode of the Smart Property Investment Show. But until then, bye-bye.
see you next time.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.